Good afternoon and welcome to HPD Trading's weekly fundamental overview. This week we're releasing the video slightly later as we wanted to see how the German elections would play out. So that's why it's being released on the Monday this week. And apologies for missing last week's video. Personal issues came up and we couldn't record it. Before we get into the fundamental overview, I just want to reiterate that this is not financial advice. This is just how we at HPD Trading see the market. So first of all, as usual, we're going to look at the general risk in the market for the upcoming week. Again, a common theme over the last and probably going to be a common theme over the next few months is the tariff risks, as well as the war in Europe and Middle East that there is talks of peace. However, talk is talk, and we'll see what happens there. So, if we look at the VIX index here, the red line here indicates where we should be looking for um, money to flow into safe havens. As you can see, we're currently below that, so it's pretty open book. The risk at this current point in time isn't too high. So let's start off with the US dollar. The US dollar recently has been experiencing a strong downtrend, as you can see from this sort of candle where we took this old high. From there, it's just been bearish price action to the downside. This is relatively counterintuitive when you look at the fundamental side of things. However, we believe this is due to the desire from the top officials, whether that's Trump or his Treasury Secretary, to devalue the dollar. So if we look to this point, the Mar-a-Lago Accord, Trump has put in place the Treasury Secretary of the US, and he personally said that there could be a Mar-a-Lago Accord on the cards. This would essentially be a conglomeration of various countries and central banks coming together to actively devalue the dollar, which is something that Trump actually wants. He wants the dollar to be cheaper. So we believe that this is potentially what is causing this price action to the downside, because in terms of the other fundamentals, the dollar is very, very strong with a strong job market and the threat of tariffs, impacting the other currencies, as well as the potential for a Russia negotiation to occur. Um, One thing to note is the interest rate cuts, the size, well, not the size will be 25 basis points. However, the frequency or the number of cuts in 2025 keeps flip-flopping between one and two cuts. So that's something to keep in mind, although compared to other currencies, the dollar is fundamentally, from an interest rate point of view, very strong. However, we are seeing this retracement here. I do feel that this bearish price action will continue. Potentially, these lows could be taken out, but until I see a real move to the upside, I'm just going to be following what is there rather than what I want to be there, and therefore I'll be looking for the dollar to come down a bit more. Moving on to the Canadian dollar, there wasn't too much exciting news out for that last week. We can see the annual inflation inched up from 1.8% to 1.9%, showing that the inflation rate is hovering around that 2% golden zone that central banks like to get inflation to reach, as this is like the equilibrium point between growth and steady growth essentially. One thing to note is that retail sales did fall um, recently, and with that, that indicates that the repeated cuts that the Canadian Central Bank have been employing are actually starting to have an effect on the market. And another thing to note is the tariffs have been delayed. We touched on that a couple of weeks ago. Um, However, the delay was 30 days, I believe, so that sort of grace period or um, whatever you want to call it is should be ending pretty soon within the next week and a half. Moving on to the Great British Pound. The pound is in a very interesting spot right now. As you can see, the last sort of week it was just consolidating around this range. Um, in terms of the Bank of England, they are in a very tricky spot with fears of stagflation. Stagflation is something that central banks definitely don't want, and it essentially is when these three sort of things are occurring, or four things, I guess, with weaker sales but higher costs occurring. So even though people aren't spending, prices are still going up. There's job losses occurring, and the business activity is stalling. So this really is a tricky spot for the Bank of England, and therefore it's quite hard to, figure out where they're going to go next and what they're going to do next. So personally, I'll probably be staying away from the pound this week until there's some more clear instruction from the Bank of England. In terms of the euro are still expecting around 3 or 4 cuts this year, with the interest rate projected to reach around about 2.2% by the end of the year. It's currently at 2.9%. A common theme over the last few weeks has been the fear of US tariffs affecting the euro, and Trump has recently said he would be implementing tariffs on various goods such as automobiles, pharmaceutical goods, or a variety of other things. So these would definitely affect the eurozone. There is concern about the job market at this point in time, and certain European central bank officials have stated their concern about the job market. And another thing to note is, as I touched on at the start of the video, the German election has now concluded. Um, whatever your political leaning doesn't really matter. The most important part in terms of trading is that the election played out as the market predicted, and therefore the next steps are to see if a coalition can be formed. If one can be formed, this would be positive for the euro. If it can't be formed successfully and in time, then this would be very, very negative news for the euro, with the German economy being the largest economy that makes up one of the euro counter components. So, actually, I should state that for this week, we could potentially see some ranging. However, I feel like most of the movement, if it's to the upper downside, it should be to the downside. Potentially take out these lows here, and from there, I expect it just to consolidate for a while. In terms of the Swiss franc, the Swiss franc has been denoted as expensive by the central bank, by manufacturing companies and lobbies, and therefore we expect it to slowly over time depreciate in value, whether this is through intervention or the carry trades. One thing to note is that last week the Swiss National Bank head said that the central bank must have the ability to go down to negative interest rates. So that would indicate to us here at HPD Trading that more interest rate cuts are coming. We expect potentially 25 basis point cuts at the next meeting, and if not that, at the following meeting. Another thing to note, actually, in terms of the Swiss franc, is with the potential peace settlements in the Russia-Ukraine conflict, this could dent the Swiss franc's appeal as a safe haven currency, and therefore give us another confluence for shorting the Swiss franc, as well as the low interest rate and the desire for the Swiss National Bank to devalue the currency. So, with all those sort of factors in mind, we do expect the Swiss franc to slowly but surely um, slowly but surely consolidate and drift towards the downside, sort of in a similar fashion to this period of time where it's up and down, but over the long term it is slowly moving down. In terms of the yen, a similar trend is occurring with the potential for a resolution of the Russia-Ukraine war. Again, as a potential, words are just words at the moment. However, the yen recently hiked their interest rates, and the central bank, the man who's in charge of the central bank for Japan, Governor Ueda, has expressed his willingness to hike rates again. This has been backed up by the increase in GDP, as well as the annual inflation and food inflation also increasing quite rapidly. So with this increase in inflation, as well as the sentiment from Ueda, we're expecting two more hikes to the interest rates before the end of 2025, leaving the interest rate to peak at around 1%. So with all this in mind, we're just expecting the yen to keep tearing higher. Um, Again, compared to all the other central banks and currencies we look at, the yen is the lone hiker. In terms of China, the president of China has had talks with Trump. However, nothing really seems to have came from it yet. There is a bit of confusion in the market right now as the People's Bank of China have signaled rate cuts will be coming. However, they have not materialized, and the People's Bank of China seems to be prioritizing stability over the rate cuts. We believe this is due to the Chinese economy wanting to become a safe and respected currency, and as such, don't want rapid and volatile price swings. And one thing to note is the Chinese government keep injecting money into the economy, even though it is still not doing too much, to be honest. In terms of Australia, they have now initiated their cutting cycle. However, this cut was backed up with hawkish rhetoric. Essentially, the governor of the Bank of Australia has said that the data or the future hikes remain very much data dependent, and therefore we're not expecting a lot of hikes to occur, and we're not expecting another hike to occur for at least another month or two. With this in mind, and also the potential for the Australian economy to get a US tariff exemption, the Australian dollar we're predicting to be a bit more of a buy compared to some of the other currencies we've touched on, whether that's the euro, the New Zealand dollar, which we'll touch on, or the CAD. And one thing to note again is the tariff threat has been studied, and from the studies that Australia have, ran, there seems to be a small impact on US China tariffs on the Australian economy. So this small impact would obviously be very, very good for the Australian economy, as with a small impact from these tariffs would not lead to an overly drastic change in the Australian economy. So overall, we could expect the Australian dollar to keep slowly moving up. As you can see, it's sort of ranged in this area. Personally, I would be expecting these highs to be targeted next. There's a bunch of relatively equal highs here. So whether that's this week or the coming weeks, I'd expect price to be going towards these highs. And then from there, we'll have to wait and see what the narrative is at that point in time. Moving on to the New Zealand dollar, and this is our last currency we're going to look at. Again, as we've touched on in every other week, the New Zealand dollar is a Chinese proxy, and therefore tariffs that affect China would affect the New Zealand dollar. The recent meeting, there was a 50 basis points cut that occurred, and there are two more 25 basis point cuts forecasted for the next two meetings. Beyond that, it's quite unclear. However, more cuts are expected, although the inflation rate is also expected to rise. So therefore, there's a real murky waters around the timing of the interest rate cuts beyond the summer. And an important point to note is the National Bank of New Zealand have publicly stated they would welcome a weaker Kiwi dollar in order to revive the economy. Whether this is for imports and exports or tourism or both is sort of up in the air, but the main points to note are the National Bank or the central bank are very much open to a weaker currency. So with that in mind, and the continued rate cuts, we're expecting the New Zealand dollar to fall, um, eventually reaching these lows. However, I doubt that would happen, this week. Although you never know in the markets, especially with Trump and his tweets, anything could happen. So that's all we've got time for today. Thank you very much for listening. As always, if you have any questions about any of the concepts we've covered, feel free to leave a comment and we'll get back to you. And have a lovely day and good luck with the trading week.